Hey guys, TommyBryson here, and over the past week or 3 weeks, I've invested over $20,000 into the market because again, everything right now is on discount. And I bought over 10,000 different stocks. And you might say, Tommy, that is way too much, it's insane, how do you do it? The answer is kind of like less exciting than it is, it's like kind of boring to be honest. All I did was I invested into 7 different ETFs that contain a ton of stocks. That way I am very well diversified, but I also make a lot of money when the market does bounce back up. And today right now is March 26th, and you guys will see exactly how much this portfolio is actually going to be worth in around 3 to 4 months down the line. And by the way, my portfolio is going to be linked down below in an Excel sheet, and that way you guys can go ahead and download it and put in how much money you want to invest or not invest, and that way you know exactly how much to buy and how much not to buy, because my entire portfolio is broken up into percentages. So it's not like, okay, I'm gonna buy this much of this. It's more like I want to buy 38% of my money into this investment right here, and that's how I do it. So all the links are down below, and all you have to do is click download or save your own copy, and that way you can edit it for yourself. Any questions, just DM me on Instagram at TommyBryson or comment down below and I'll help you out, okay? And by the way, I have new videos on investment coming out very soon, so make sure you guys subscribe to the channel and hit the bell so you get notified, because again, I also do post videos every single day on YouTube. Now, the very first thing is this, guys. Whenever it comes to investments, your goal should always be, I want to buy low and I want to sell high. That's all it is. You want to make a profit. You don't want to lose. You don't want to be the guy to buy all the way up here and then sell all the way down here, and then boom, all your money is gone. So the point is, okay, when everyone is buying, the price goes up. When everyone is selling, the price goes down. So it's kind of like right now, it's like the Black Friday of the stock market, but there are no lines because again, everyone is just selling and you can be the one buying and making money. Now, the very first investment of part of my portfolio is actually Vanguard, the S&P 500, and this ETF, the ticker symbol by the way, is VOO. Now, I always wanted to invest into, for example, Amazon, Apple, Google, all the big companies out there, including Berkshire Hathaway, that cost around $200,000 last time I checked. But the point is, those companies are very expensive and I can't afford to put in so much money into those companies because again, I will be going cashless. So the only way I managed to actually invest into those big companies is by buying this ETF that contains the top 500 companies in America, and that way I have a piece of the pie without having to invest all that money per share, but instead I just owe a piece of all of them all together, okay? That's what I like about investing into ETFs. So for example, guys, okay, how much do I invest into this, guys? I invest around 38% of my money into this investment right here, VOO. But on top of that, guys, my favorite thing is that with this investment right here, what you basically do is you track the market. So whatever the market makes that year, you'll make something very similar to it, and that way you're not losing a ton of money by trying to beat the market. So for example, guys, okay, if you invested $10,000 10 years ago, okay, in 2010, well, in reality, your money would be worth today in 2020 around $30,000. We're talking about 3x your money in 10 years, and that is a pretty solid investment if you ask me, okay? Now, and if you're wondering, well, Tommy, how much money exactly did you put into this investment over the entire crash that happened? Well, in reality, I put in $20,000. You times it by 0.38% because again, I do only put in around 38% into this one right here, and I invested around $7,600 right then and there into this investment. And when I bought it around 215. So in reality, divided by 215, that is around 35 shares right out the bat. Now, you guys will see this. In the few months to come, you guys will see exactly how much money I'll make more, and I'll post it here on the channel also because again, the market is down, but it will go up, and you guys will see exactly how this transfers over to my money. Now, the second investment that I made is actually into Vanguard small cap companies. So it's basically like small cap companies, and the main thing is this, guys, the ticker symbol for this is actually VB. Now tell me, why would I invest into small companies? I don't want to do that at all. I want big companies because they're more stable. Well, the answer is because big companies are more stable, the profits are more small and also more stable. But with small cap companies, although it's not like, oh my gosh, it's like the best company out there, but the main thing is that they do have surges of growth very very quickly because they're smaller and they can grow a lot faster, but they can also fall a lot faster also. Now, when I do say small companies, I don't mean like, the store next to your house. I mean a company that's worth around $300 million to $2 billion. That's what's considered small in the stock market world. Now, this ETF right here holds around 1,347 different companies, and for example, or stocks, and for example, if you had invested $10,000 in 2010, that money would be worth right now around $29,000. So almost 3x, not that bad at all if you ask me, for investing to small companies worth almost $2 billion. Now, guys, how much money do I invest into this? The answer is very simple. I only put around 14% of my money in here because, again, although it's pretty solid, has a good track record, it is bigger dips and I don't want to experience that. So the point is, I don't really want to go that much, and I only put around 14%. So 14% of 20,000, well, that is around, times 14%, that is around $2,800. And when I bought this, I bought it around $104, divided by $104. So I bought around 26 shares right then and there. Now, if you guys are wondering, well, tell me, how do I invest by percentage when I won't have enough money to buy a full share? The point is, if you can't really do that, like buy a full share of a company or an ETF, all you have to do is use the Cash App that lets you invest partially. So if you want to invest with $1 or $5, you can do that if you want to, or use Acorns, which is what I use to invest my money also, and that way you can invest with $5, and that way you're good to go and don't need the full amount of money right then and there, okay? Now, number 3, guys, is actually emerging markets. The ticker symbol for this one is VWO. Now, to be honest with you, I'm gonna be honest here, this is a lot more risky because it's kind of like more like worldwide, and it's markets that are coming up, but basically they're worldwide, so they carry a lot of risk to them, and they also carry maybe a lot of growth to them if it actually does work out, but you don't really know. And when I say emerging markets, I mean basically in China, Brazil, or for example, even South Africa. Now, the point is, whenever you're investing into emerging markets, what you really want to do is diversify your money, and that way you don't really fear like, oh my gosh, I'm gonna lose all my money, what happens if it goes down or whatever. The answer is you want to diversify it, and that's why Vanguard, the company that holds this ETF right here, has around 5,000 different stocks that are held in this ETF right here, and that way you are 100% diversified. Now, the graph for this investment right here looks like this. So again, it goes like this. So it's very risky, but it can also spike very high. And if you sell right then and there, well, you're golden. However, okay, if you invested, for example, $10,000 into this investment right here in 2010, your money would only be worth around $13,500 compared to $29,000 and $13 before. That's nothing, right? However, guys, okay, if you invested that money in 2010, literally in 2012, you could have made that $3,500 profit right then and there if you sold at its peak. So the point is, it goes high very quickly, but it can also come down very quickly, and then you kind of like average out. So the point is, if you're going to invest long term, you're good to go. But if it's more short term, you got to find that balance in where do I buy, where do I sell, and that's why I only invest for the long term, because I can't really predict the market. Warren Buffett can't do it. No one can do it, okay? Let's be honest. Now, when it comes to emerging markets, guys, I only put around 4% of my money because, again, I don't want to take that much risk. So 20,000 times 0.04, well, that's around $800. And when I bought it at around $30 per share. So in reality, I think $30 per share, or even maybe even less, to be honest with you. But let's say 30, let's go high. And then I like to go high, never low, because that way, if I made money, then I made a lot of money. But if I lost money, I didn't lose that much money, okay? That's the point here. But $30 per share divided by 30, and that is around 26 shares right off the bat. But again, it's pretty solid because I don't really want to take that much risk when it comes to this company. Now, the fourth ETF is actually Vanguard Real Estate, and the ticker symbol for this one is actually VNQ. Now, I can't go out there and buy a skyscraper or a whole public building or anything like that. However, by investing into this ETF, you actually are a part of companies that actually do that also. So you get a part of those returns and profits without having to be the one to actually buy the skyscraper. Now the main thing is this, guys. The main thing is that whenever you invest into real estate or REITs, whatever you want to call it, the point is it's kind of separate from the stock markets and also the bonds markets, and that way you're more diversified when it comes to real estate and you're more consistent and balanced out. Okay, so if the stock market goes down tragically, it does not mean the same for the bond market or also the real estate market, and that's what I like about it the most. Okay, so for example, guys, some investments that they do hold here are around 184 different companies that hold a ton of real estate here in America. So for example, if you ever gone by and you saw like this big like orange sign saying like public storage, like to store your stuff if you have too much stuff at home, which I don't really understand that business, to be honest. If you have too much stuff at home, just like sell it and get rid of it. Don't pay for it to like store it up. Okay, the point is they hold around 184 companies that own skyscrapers, a whole bunch of real estate in America, and that way you get a part of that without having to worry about the market going down over here with the stocks, or for example the bonds market going up or down. Also, it's kind of like more separate, and that's why I invest around 8% of my money in here. And by the way, if you invested 10K 10 years ago, that money would be worth today around $29,000. And that's why it's a pretty solid investment, almost a 3x also, and it's pretty good if you ask me, okay? And by the way, guys, 8% of $20,000 is around 0.08, is around $1,600. And when I bought it, I actually bought it at around, I think around like $60 or $56. So $56 divided by $56, well, that's around 28 shares right then and there. Now, I know it sounds like, oh, Tommy, that's not that many, but in reality, guys, by having a balanced portfolio, you limit the risk, and over time, if you keep investing over and over every single month, your growth, your profits, how much money you make will be a lot by the time you actually done with it. And for me, I plan on being done with investing in like 40 years or so when I'm like 60 or like 63, but I plan on taking my dividends when I'm like 40 or 45 or so, maybe, okay? Or maybe I'll wait longer, but by the time I'm 30, I'll be making around $1,500 every single month in dividend payments only, which is awesome if you ask me. And now, guys, number 5 is actually investing into developed markets. Now, by the way, the ticker symbol for this one, guys, is actually VEA. Again, everything is linked down below. You can find it if you want to very quickly on Google. But the point is, by investing into developed markets, what they mean is, for example, markets in Europe, in the Pacific regions, and also in the United States. But I've noticed that around more than 50% of all the investment made here are going into Europe. For example, into companies like, for example, Toyota, or for example, even HBC Bank, which is also a European bank if I'm not mistaken. But the main idea is you want to invest into developing markets, well, not developing, developed markets ready, because although you might say, well, Tommy, the best market is the American market, but that might be true right now, but we never know what might happen in the future. And next thing you know, you want to have a good amount of money there just in case something does change. Now, over the past 10 years, if you had invested $10,000, you wouldn't have made that much money, to be honest. You only would have made around $18,000. So an $8,000 profit, it's not that much compared to everything else here. But again, it all depends on how things keep developing. And over the next 50, 100, 150 years, we don't really know how everything is going to develop. So it's good bet to actually, invest also into other markets. And that way you have the opportunity that if the American market is being hit hard, well, I know for sure my European market is pretty good and pretty stable, okay? So that's the point. You want more balanced and not just like, American-wise, but also worldwide also, okay? Now, what I invest into this right here is around 16% of my money. So again, $20,000 invested times 0.16, that is around $3,200 right off the bat, which is a very good stake if you ask me. Very large, by the way. Now, when I bought it at around, I think around $28 or so. So divided by 28, that's around 114 shares right there. Now, this seems like a lot, I know, but again, it is a little bit more risky. And on top of that, you're not really making a ton of money compared to the US market, but that could change in the long term, okay? It could change, so it's always good to have some money also outside of America. Now, the last 6 and also 7, the last number 6 and 7, well, these are not really investment into stocks, but more into bonds. Tommy, why are we getting into bonds? Bonds are boring. Well, the idea is that you want to have bonds, and that way your portfolio is more balanced. Because again, when the stock market goes down, bonds usually go up. And then usually kind of like real estate kind of like stays the same or kind of goes up or down. But the point is you want to have balance all over the place, and that way your portfolio doesn't go like this. It goes like, oh, okay, let's just balance it out right here. Okay, that's what you always want, and you want to grow steadily, not like this, because that's insane to me. Okay, now when it comes to my bonds, guys, my bonds are also ETFs made out of a collective of a lot of securities issued out by the federal government. So for example, I invest into iShares ETF, and the liquid symbol or the ticker symbol for this one is actually SHY. Now right here, guys, what this means is that you invest into 1 to 3 year notes issued out by the federal government, and that way they pay you interest for holding on to securities right then and there. So if you had invested $10,000 in 2010, well, that money would be worth today around $14,000. So only a $4,000 profit, but again, is pretty good, not that bad, and also gives you stability when it comes to your entire portfolio, because the bond market goes like this, guys. It's like this. It's very boring, but it's stable, Stocks might go like this, but this is like, it's more stable. You want stability in your portfolio. So right here, again, I invest around 10% of my money, and 20,000 times 10%, well, we all know the answer to that. That is $2,000 right off the bat. When I bought this, I bought it at around $85 or so. So divided by 85, well, that's around 23 shares off the bat. The idea is you want this in your portfolio to make sure it balances out when the market does go down for the stock market, because it does have a history of going down, but the bonds actually, just stay like more constant, and that's what you want. Now, the last investment that I make is actually into corporate bonds. I know this video is pretty long, but if you made it all to the end of the video, you have a large knowledge now of different investments you can get into if you want to. Now, the last one is corporate bonds, and the ticker symbol for this one is actually LQD. Now, Tommy, what about corporate bonds is different from, federal bonds? What's the difference? The answer is very simple, guys, okay? Corporate bonds are more risky. More risk, more reward, more risk, basically. You can lose more money, basically, right? But the idea is that you want to invest into an ETF. This way, you minimize the risk. For example, if I told you I own a big company, I'm the owner of Apple, buy my bonds, okay? I'll pay you later. But then I go down. Well, now you're kind of like, oh my God, what just happened to my money? But you also get paid first before people that actually own stocks do, by the way, if you didn't know that. But the point is, having corporate bonds are more risky, and that's why I have ETFs and not just like individual companies out of it, okay? So with this investment right here, I put in 10%, but also, if you had invested $10,000 10 years ago, well, your money would be worth today around $27,000. And the companies include, for example, JP Morgan, BOA, Apple, Amazon, Microsoft. All these companies have bonds, and you can buy it by buying LQD. So imagine this, guys, okay? Everyone says the bond market is boring, but making literally $17,000 in profits is not that bad at all, if you ask me. And by the way, when I did buy it, they are a little bit more expensive than, treasury bonds. So basically $2,000, and I bought it at around $115. So divided by 115, well, I only bought around 17 shares. But again, it's pretty good because the market is down right now, but bonds kind of go up, but you still want to have them in case anything does happen. You kind of like average out. Not that bad at all, if you ask me. But guys, comment down below and let me know, out of the 7, are you going to copy my portfolio word for word? By the way, again, I have an Excel sheet. All you have to do is put in into the red part of it, just put in the amount you want to invest, and then everything will adjust. If it doesn't adjust, I made sure to put in instructions, and that way you know exactly what to do. But the idea is, by having a portfolio made out of companies from America, outside of America, bonds, real estate, corporate bonds, federal bonds, this way you have more balance and you grow over time. And on top of that, my portfolio pays around 2.55% in dividends every single year, but after the expenses around like 2.35%. So not that bad at all for holding investments that show a track record of literally making money through bad markets, good markets, and that's what you want, okay? You want balance, consistency. You do not want a movie, okay? You want consistent income for yourself. And guys, basically, comment down below and let me know, what do you think? Is it good? Is it bad? Are you gonna try it? Comment down below, let me know. And if you want to do it yourself without having to do everything here, just invest into Acorns using the moderately aggressive setting, link down below, and that way you are good to go. And as always, if you enjoyed this video right here, like this video and I'll make more videos like it. And on top of that, also subscribe to the channel, hit the bell so you get notified. And if you want to talk to me one-on-one, uno, just DM me on TommyBryson. And before I go, if you want to watch a full video on how I invest with Acorns, here it is right here. Click my face right here to also subscribe to the channel. I'll see you guys tomorrow. Thanks for watching, and as always, peace.